2017 begins with economic uncertainty amid measured global growth, picking up from 2016 at an average of 3%. By looking into the economic drivers and risks globally, including oil and gold, as well as within the US and China, UK and the EU, and emerging markets, this uncertainty becomes prevalent. The global economy is trending upward, with several predicted driving factors. Developed world inflation, the transition to fiscal-based growth, an accelerating US economy, and the softening of the euro and the yen may be key drivers for this year.
In economic foreign policy, there is already a backlash against trade, against globalization, against migration, and that's going to be worsened by the US policy. There is a risk of trade and currency wars.
Yet several risks highlight the uncertainty of 2017 and risk undermining potential growth. Anti-establishment populist politics will continue to carry weight into 2017 with several key elections. This threatens globalization with trade wars and the integrity and independence of monetary policy. Further economic risks are triggered by a stronger dollar and interest rate hikes, creating fiscal headaches for many countries. Emerging market and Chinese non-government debt and capital outflows may add to global economic woes. Oil, contingent on the December 2016 OPEC agreement, has slightly recovered and may continue to stabilize in price. Upward global economic growth will benefit producers and could help encourage investment. U.S. shale could be a spoiler with lower production costs and Trump's energy policies. A stronger dollar may also encourage agreement violation. Gold has several factors working in its favor this year, including inflation, higher demand, and uncertainty. Risks include a stronger dollar and ROI potential that could drive gold downwards. Focusing on the US and China will be vital for 2017. The world's two largest economies will be undergoing uncertain transformations, yet have ample opportunity to grow. The US's growing economy will encourage investment through low tax proposals and expansionary fiscal policy, while China's ability to keep the yuan low will help drive exports. Downside risks to both economies are numerous and substantial. Impending trade barriers and retaliation between the US and China could seriously harm Chinese exports and boost American inflation, harm specific US sectors such as agriculture and US treasuries. The Chinese leadership may be sensitive to any domestic or international threats to their economy, resulting in overreactions. On the other hand, political gridlock could increase US policy uncertainty. Economic overheating and equity bubbles are a potential in both countries, as the bullish U.S. markets may have run their course and Chinese market volatility remains evasive of government intervention. External Chinese debt is made more expensive with a stronger U.S. dollar, the latter of which hurts U.S. exports. And lastly, China's corporate debt has been upwards of 250%, while U.S. government debt will likely increase with Trump's economic proposals. Moving into Europe, many similar trends can be found. The United Kingdom and European Union have cautious expectations of growth and inflation. The euro and the sterling pound are expected to trend downwards, helping exports, inflation, and other sectors in both economies. Increased spending is expected to help growth in the EU and is being considered in the UK. Central banks are expected to maintain either near zero or negative interest rates, while the EU is expected to extend bond purchasing programs. Global growth and low commodities will help drive these economies. Downside risks for the UK and the EU are plenty. Primarily, risks stem from Brexit uncertainty and the right-wing populist protectionist success in French and German elections. This uncertainty will pose a threat to investments, consumer spending, and EU integrity. Furthermore, uncertainty stemming from Brexit and the EU may become more severe if Italy's banking woes become contagious. All of these trends, plus the potential for monetary policies not in line with the Fed, could potentially lead to a substantial outflow of capital. Emerging markets and the Middle East and North Africa region both have upside potential and downside risk. Brazil and Russia are expected to break their recession as demand for emerging market goods and services rise. Russia's equity and investment environment and recent OPEC agreement will help. Many emerging market countries will continue to implement structural adjustments, leading to capital flow, which is also encouraged by stock market potential and higher interest and bond rates. Recovering commodity prices are happily embraced by many MENA countries, and current prices are expected to maintain. The recent oil glut has ushered in an era of spending efficiency and optimization through reform, while many MENA countries have ample space to take on more debt, especially considering their relatively attractive credit ratings and low external debt.
they will have to raise interest rates. When you are pegged to a currency, you give up your independent monetary policy.
There is a considerable amount of risk in these markets. The MENA region will continue to be threatened by many sources of instability. Oil export market share may be threatened if OPEC members violate the production agreement. Fed rate increases and the surging US dollar makes debt more costly, hurts tourism and capital inflow, and the foreign reserves of US dollar-pegged countries. The era of austerity will also hurt spending and consumption. Liquidity and structural issues will also impede on continued MENA growth. Lastly, uncertainty in U.S. trade policy and the potential for deglobalization hurt economic growth prospects, sending shockwaves through global supply chains affecting emerging markets. 2017 may be the onset for major political and global economic shifts, many of which started in 2016.
From January 20th over the course of 2017, and that is the principal driver of risk in the global markets today.
Uncertainty in politics, especially in the US, China, and the EU, may make or break this year's economic performance.
In the 20s and 30s, the US became America first, isolationist, unilateralist, and that led to the rise of aggressive power like Germany and Japan, and then war.
This uncertainty may also undermine efforts to combat some of the world's more pressing long-term issues, specifically climate change, growing inequality, and cybersecurity weakness. The absence of global leadership, instability in institutions from international to local, and increased isolationism hints to Ian Bremmer's concept of the beginning of a geopolitical recession, putting more of an emphasis on rhetorical politics rather than empirical economic policy. As we begin 2017, three major transitions should be considered. These transitions will be challenging, and without careful leadership and policy, 2017 may be looked back upon as the year that spun the world into calamity and the true breakdown of the US-led world.